Welcome to Yahoo Finance's special coverage of the January Consumer Price Index report. We are getting the numbers, and month-over-month inflation 0.2%, a little bit more subdued than the 0.3% month-over-month gain that economists had expected. Core CPI month-over-month 0.3%. That is a little bit of an acceleration. That's in line with analyst estimates. And then just as we saw the month-over-month coming in a little lower, we see it for year-over-year 2.4%. The headline consumer inflation number year-over-year, core CPI year-over-year 2.5%. Now, one caveat as we look at these numbers, as we look at all of the economic data, is just a reminder that we did not have these numbers in October or November because of the government shutdown. So there is a little bit of potential distortion in some of the comparison numbers also as we go back, and in terms of the data that was able to be consistently collected over that period of time. So that's just something to keep in mind here. Again, the headline number 0.2% month over month, and the core number excluding food and energy prices up by 0.3%. Now, we were just showing what's going on in the markets as a result of this, and just wanted to take another look there. So we've got stocks that are really little change to the upside, but it's important to mention as we get this report this morning, the market backdrop, which has been rocky to be sure, where we saw once again yesterday a sharp sell-off in tech stocks, and really day after day, you know, the market seems to be on a hair trigger in terms of anything having to do with AI and the industries or even individual companies that it could potentially disrupt at some point. Just a lot of sensitivity around that issue. Layer onto that the consumer environment that we have right now, which is also a sensitive environment, particularly for the lowest income cohort here in the United States. So amidst all of that, here we have this consumer price index report. And let's talk more about it now with our panel. We've got Vishal Khanduja joining us now, Morgan Stanley Senior Fixed Income Portfolio Manager. We've got Gregory Daco here with me in studio, EY Parthenon Chief Economist, and Claudia Sahm, New Century Advisors Chief Economist and former Federal Reserve Board Economist. Claudia, I want to start with you. I was looking at some of your commentary ahead of time, and you talked about that January sometimes does see a little bit of a bump up in inflation because you have sort of a price reset maybe at the beginning of the year. It doesn't look like these prices necessarily reflect that, but how do we cut through sort of the noise of the past couple of months to read this number?
Right. Well, in fact, if we look at core CPI, so in the month of January, a 0.3 increase, that is a bump up from what we saw in the fourth quarter of last year. Now, granted, we only had 1 month, in December, but it was 0.2. So we actually did see a pickup in January, and that 10th fits kind of the historical pattern. So I think that was where consensus was building this in, and we saw it, but it wasn't, a really big number. And frankly, these data, this is a good news print, right? We're seeing the disinflation's continuing. So gradually, but, so even with January notwithstanding the little bump up, like it is, I think there's some really good signs in here.
Greg, what do you think? What's your reaction here to this?
Yeah, I think I largely agree with what Claudia is saying. You have to look at the trends, not 1 month. We know that January tends to be highly volatile in terms of economic data, in terms of CPI in particular, because that's when your gym membership price gets reset. That's when your streaming service price gets reset. That's when some of the discounts from the holiday season get removed. If you look at this report, there are very interesting developments. There was a big drag from lower energy prices, which curbed some of the headline print, and that's why core is higher on the month-to-month basis. You did see some pass-through from tariffs in apparel prices rising. You also saw, and this is important, in transportation services, an increase in prices. I was just
looking at that number, 1.4%. What is that about?
It's very interesting because when you see these types of increases in sectors that are cyclical, that are sensitive to demand, it tends to portend to an environment where you have this polarization and where some consumers are still spending relatively freely, and where that strong demand matches more reduced supply, and you have these upward inflationary pressures.
I mean, what does transportation services include?
So it's air travel, it's regional travel, urban travel, bus travel. So it's all train travel. It's all the different forms of travel that are included in transportation services. What's interesting is that also when you broaden out the services, you can look at some of the automotive services, like repair shops, for instance, and those tend to reflect in turn how car prices have been evolving. We've seen a lot of volatility in car prices. These were also elements that were highly volatile this month. Used car prices falling sharply, but new car prices are on the rise. Maybe, again, some of the pass-through from tariffs there.
Yeah, interesting. Vishal, let's get your take on this too, because obviously what we're trying to do is figure out, put this together with the jobs report that we got earlier in this week on this mixed up economic data week where we usually be getting the timing a little bit differently, and we're trying to get insight into where we are on the Fed's dual mandate, of course, of full employment and stable prices. So what is this doing for us on the stable price side of the equation and what it's telling us?
A fantastically relief number is what we got. I think if you look back, probably the last, I was reading about it, the stats, the last 11 Januaries, 10 of them have actually beaten above expectations. So this one actually goes against that. The expectations of the number were much higher, given the seasonal bump and some calculations that some of the economists still are trying to catch up to, as Claudia mentioned. So a relief number, that's what you're seeing in rates this morning, slight steepening pressure coming back into the curve here. Traders pricing in about 50% chance of a third cut this year. All that, going to Claudia's point, comes back to the same point that the front end is pegged. Economy is doing well, but yes, it is slowing. Labor market is slowing. We saw a stronger print. Again, one print doesn't make a trend. We know that the labor market is slowing, not considerably. And then this number also goes back into that same mix of the dual mandate that we are not significantly rising from here, or we are not seeing the pressures that will make us believe that we are back onto that trend of hiking inflation. So stubbornly high, but still have those elements within the report that tell us that we are slowly but steadily going to come back down in the back half of the year, which will allow the Fed to do its thing in the back half of 2026.
So, Claudia, if we take a step back and if we looked at a longer term chart of the CPI, both headline and core, we see, of course, the big spike post-pandemic, and we see the come down and the sort of now sideways to slightly lower movement. So I guess I would ask overall how encouraged you are by that trend, how much you think it's going to continue, and also how do we think about tariffs as an input to all of this at this point, since I keep hearing sort of different things about where we are in terms of when it's going to show up more or if it's going to show up more.
Mm-hmm. Right. So I think, broadly speaking, this is encouraging. Now, it fits in the Fed wants to gather more evidence, right? They really want some evidence that inflation is moving back down to 2%, particularly with a labor market that seems to be doing fine, right? Like there's not the urgency to cut because the labor market. So now it's like, okay, let's look at the inflation data. I think today's data probably will sit on the side of the ledger of this looks like progress, but they're going to want more of these, right? One good month is not going to cut it. And then this question about tariffs, really the reason we didn't see disinflation last year is because core goods price inflation picked up, right? And that, it really seems like that's about the tariffs and some of the pass-through. So it's like getting into the nitty-gritty of these data and trying to see any signs of places where the pass-through is kind of completed into the price level and the inflation is starting to go down. And that really requires a fine-tooth comb into the data. I suspect this, again, will show maybe some early signs of it, but it's really an empirical question because it's really complicated how tariffs work through the economy. And, we might also get some relief on the policy side. There's reporting that the White House may be, reducing some of the tariffs on steel and aluminum. So there's another way we could get some good news on inflation, not just from the data.
Yeah, and we've sort of gradually been getting these rolling reliefs on various parts of the tariff equation. Once the White House said, oh yeah, we don't grow bananas and coffee here in the United States, maybe we shouldn't tariff those things. So that's, although I'm just looking at coffee or seeing that still up 18% year over year, which is not good for my morning costs. But in any case, so Greg, how are you thinking about now the future path of inflation? And to Claudia's point, as we sort of dig into the components here today, what then predictive power we get from that?
Yeah. So I think one thing that is clear is that we are in an environment where the CPI data is understated because of the government shutdown's effect on data collection and because of the fact that the BLS used a carry forward methodology, assuming essentially zero inflation towards the back end of last year. So that is weighing down on inflation. I would assume that CPI inflation, absent that, would have been about 3 to 4 tenths higher than it currently is. So that's the first thing to keep in mind. The second thing to keep in mind is that there are strong cross currents affecting inflation. On the one hand, you have strong disinflation coming from the shelter side of the picture, the housing side of the picture, which is weighing on inflation data. And on the other side, you have an environment where there is still tariff pass-through. It's not the type of huge pass-through that we saw post-COVID with inflation surging, but it is 1 percentage point of pass-through onto consumer prices that is filtering through. And so as we look at the rest of the year, I think we're going to be in this environment where the key gauge that the Fed measures, which is PCE inflation, is going to be hovering around 3%, which is too high for comfort for many policymakers, and then edge towards 2.5% in the back end of 2026, which will allow for some potential easing should there be a further deterioration of the labor market. But I would be very cautious with assuming that the Fed is going to be easing on the back of this print that is easier than expected in terms of inflation. This is not satisfactory for them. Claudia is absolutely right. The Fed wants to be cautious and careful, especially given all of this volatility in the data.
Yeah, and Vishal, I want to ask you about that too, because after we got the jobs report, right, we had the sort of expectations about the next Fed cut being pushed out a little bit to sort of July from June. So not a huge change, but does this move the needle in either direction at all?
Slightly for the day, but I think by the time you wash out this data and the expectations that are getting repriced in the rate market right now, I think by the end of next week, we'll be back onto that bimodal outcome of 2 cuts. We don't think, if you take a big step back, I think the way the economy is shaping up, and I know the data is choppy and inconsistent, and the cleanliness can be poked a hole into, but I think what we are seeing from not only the economic data, but also the earnings reports that we're getting from companies, that overall strength of the economy is still there. Yes, we are seeing weakening a little bit of the labor market. We're also seeing the K-shaped sort of economy, but overall, the path towards what the Fed would do is very bimodal. Right now, if you look at the economy, they probably don't have to do anything and wait for the data to show them the path. But then if we think about the positive situation from or maximum sort of productivity gain that you could start seeing some effects from AI back half of this year, and the employment picture truly deteriorates, then the bimodal outcome will show you that maybe they have to do 4 to 6 cuts. So I think the market is going to be probably around this 2 to 3 cuts that they'll price it for the next 12 months guiding forward. And that to our from our base case seems like that's where the market is going to be for a little bit here till the data cleans up.
And you guys, we can talk about these numbers all day and the individual components, but we also have to talk about how people feel about the numbers. And Claudia, we've had this discussion quite a bit, right? That, even if you see easing of the pace of inflation in some areas, even if some areas you see outright, declines, that there still is this settled in feeling that people are grappling with higher price. And we've been hearing that from companies that have been reporting, consumer companies over the past couple of weeks, who have said, we have to manage price very carefully and feel like we're offering value. And so, as we know, the White House has started to react to that whole affordability question with trying to offer measures here. How do you expect that to sort of play out, and will it make a significant difference in how people are feeling?
Right. So we have to remember, people pay prices. They don't pay inflation, right? Like we're trying to get like a pace of price increases that's back to normal. And it's been a very gradual process. And there was a period of time not that long ago where prices were well above the pace, or inflation was well above the pace that we're used to. So like it adds up in the price level. So I think that's where we talk about 1 month, we don't want to overreact on the progress on inflation. My goodness, 1 month of good inflation data does really not move the needle much on the price level issue. So I think that's where but it's a tough nut to crack. So, any administration is going to have a hard time. The last administration did as well. So I do appreciate the taking it seriously with affordability. And there are some levers to pull, particularly thinking harder about the tariff policy that really is pushing costs into the economy. So, if they're more targeted, that really could help. It's not necessarily going to reverse the price increases that have already gone through, but it could make some progress. But yeah, I don't expect people to be happy today, but it is, we're a step towards progress, less inflation. It will make a difference over time.
And Greg, what do you think? What's going to move the needle? Is there anything that can more significantly move the needle on a policy front? Is it tariffs? Is there something else also that the administration can be doing?
Well, I think the key issue right now is that we have inflation that is above 2% at the current time, and that is the result largely of tariffs. So if we were to adopt a policy that removes the tariffs, then you would see some downward pressure on inflation and move back towards 2%. But Claudia is absolutely right. What matters for people is the price they pay in the grocery store. It's the price they pay at the restaurant. It's not the overall rate of inflation. I would argue that 2.5% to 3% inflation is not dramatic in normal times. But the fact is that we've accumulated so much price increases that people's income and their capacity to spend has been eroded over time. And that is my key concern for the economy as we look into the rest of the year. We're in a jobless expansion. Okay, that's perfectly fine if we have a massive negative shock to labor supply and the unemployment rate is not rising. But a jobless recovery, a jobless expansion can turn into an income-less recovery or an income-less expansion if there is a subdued trajectory for wage growth along with no job gains. The combo of no job gains and weak wage growth or weakening wage growth means that people's income is under pressure, and it means that they have to find other ways to spend, dipping into their savings, using credit. Those are not the type of things that you want to see because it's not sustainable in terms of driving growth. So we have to be conscious of this whole paradigm in which we have higher inflation and lower income growth, which is constraining people's spending capacity.
Well, on that cheery note, we gotta leave it there. But hopefully we'll get more progress on the inflation front, at least in the coming months. Vishal, Claudia, Greg, thank you so much. Really appreciate it. Coming up, we'll have more on that January CPI report, breaking down some of the categories where we saw the biggest and smallest increases. Let's take a look at the reaction to the Consumer Price Index report. Jared Vickery is here with us for a look at those movers.
Thank you, Julie. Let's take a look at the stock index futures here. I'm circling them in the upper left in the Wi-Fi interactive. Everything positive, but just barely for the major indices. Here is the E-mini Russell 2000. That is the best performer of the group, up about 0.4%. You can see it was in slightly negative territory all night long, since midnight anyway, until we got the report. A little bit of a jump on that. And if I compare that to the S&P 500, for instance, you can see not a whole big of a reaction right there. And let's just remember, it was a few days ago that we got that big jobs report. We saw a nice bounce off of that, but that was reversed into the end of the day. So we don't know what's going to happen until the closing bell sounds, and that's in a few hours here. Here is what the bond market is doing. These are 2-year Treasury note futures. These go opposite yields. And so since these are up, we know that yields are coming down a bit. That's in the 2-year tenor. Let's check out the 10-year. Very similar story there. And let's check out gold as well. That got a little bit of a pop on the announcement, but it's retraced some of that. Still up about 1% of the day, just shy of that big $5,000 per ounce mark. Here's what silver is doing, kind of a similar chart there, a little bit of a bump and give back. And we can also check on what Bitcoin is doing. Sometimes you get a reaction there, just a small one. It was already up, looks like the price 67,240, yet it is down about 1% over the last 24 hours. Now let's take a look at what the sectors are doing. These are all large cap, and this is what happened yesterday. Utilities were leading along with staples and real estate as tech fell, but let's put some morning quotes on here. And we got industrials and tech healthcare, utilities, financials, discretionary, all those in the green right now. And leading the way down, we got energy, but just down by a little bit. One of the bigger losers yesterday. So really not a whole lot of action. And we'll just briefly check on what's going on in the NASDAQ. Kind of a mix of red and green there. I know there's a lot going on, but finally I will wrap up here with the Dow. Another kind of mix. NVIDIA, Apple up, so is Microsoft. Meanwhile, Walmart, which has been doing nicely this week off of that staple safety trade, that's down about 0.5%, as is Amazon. Julie?
Talk much more later on about the wild week that we have seen
Yes.
In the markets and a lot of big moves. So looking forward to that, Jared. January inflation, as we've been talking about on the consumer level, coming in broadly in line with estimates, a little bit better on the headline number, rising 2.4% on the year. If you strip out volatile food and energy prices, the core number came in at 2.5%. We want to look under the hood as well and look at the categories with the largest increases and decreases. So year over year, some of the biggest price increases came in personal care, food away from home, let's say going to restaurants, and non-alcoholic beverages. The biggest decreases coming in gasoline, dairy products, and overall energy. The top month-over-month price increases in airline fares, personal care, recreation. The decreases of top month-over-month price decreases that were gasoline, used cars and trucks, and overall energy. So those were some of the biggest moves that we saw, highlighting some of the categories that contributed a lot to inflation last January but cooled off this year. Parthenon Macroeconomics highlighting things like parking, video and audio streaming, and live events. Last January, parking fees surged 6.4% according to Parthenon, largely because New York City introduced its congestion pricing. But this time around, we didn't see that, that kind of copycat. We saw a Netflix price increase last year that was not repeated this year, so you didn't see that. So in other words, you get a lot of idiosyncratic inputs into some of these very specific categories. I noticed sporting events, for example, under the category of live events, that we did see prices decline for that this year. So we're watching all of these inputs here. And as we said, the economists we were just speaking to saying we are looking for a longer term trend to see further disinflation. That is a smaller rate of inflation. As Claudia Sahm just said a few moments ago, we pay prices. We don't pay inflation. So the levels are also important. All right, stay tuned for Morning Brief. We got more coverage on the CPI report and what's going on in markets. That's next. Welcome to Morning Brief. I'm Julie Hyman. Let's get a check in on stock futures. We just had the consumer price index coming out just about 30 minutes ago, and we saw on the headline number the month over month increase was 0.2%, a tenth of a percent better than economists estimated. The same is true for the year over year number. If you look at the core number, that's the one that the Fed pays more attention to. Excluding volatile food and energy prices, we got an increase of 0.3% in line with estimates. All of this means that stocks are not much change. We see a little bit of an increase. And this is on the back of what has been volatile action, choppy action in markets, particularly on the tech side, where we have been seeing a lot of the sell-off spreading, actually, not just within tech, but beyond tech, to anything that is seen lately as facing some kind of threat from AI. So it has been a wild week. But right now, things kind of calm. All three major averages indicating a very slightly higher open. So let's talk about the market here as investors digest this inflation data and we head toward the market open. Joining me now, Amanda Agati, PNC Asset Management Chief Investment Officer, and Jane Foley, Rabobank's Head of FX Strategy. Glad to have you both here. Amanda, I want to start with you, and let's talk about what this CPI number means, or I guess doesn't mean, given the not huge reaction to the markets here this morning.
Well, it's great to be with both of you. Good morning. It's a little bit of a snoozer. It's Friday the 13th, but it was not a scary result by any means as it relates to the CPI data. And I think the market reaction is spot on, like a little bit improved versus overnight hours, but not enough to write home about. I think it really is enough, though, to say that the Fed could cut later in the year, not imminently. But that trend line seems to be weaker. And so that's, modestly good news for the market. I think the market gets to just refocus on earnings, CapEx, AI, et cetera. So we're just getting this out of the way, I think, for the market.
And Jane, what do you think? How are you viewing sort of the backdrop here now? If you put the jobs report on Wednesday together with the inflation data we got today in terms of the path for the Fed?
Well, again, I would have to agree. If you look at the jobs data first, well, that was better than expected, and the market therefore became a little bit more fearful about when can the Fed cut interest rates next, maybe not until July. So it was focusing on the CPI report to see if that would bring any sort of clarity on that. And I don't think it's really changed the outlook very much at all, because, yes, okay, the headline rate was a little bit better than expected, but the core one is important. That came in bang in line with expectations. And at the end of the day, even though economists for a while have been forecasting that US CPI inflation will decline this year, it's still right now above that 2% target level. So it's still a little bit on the firm side. And that probably leaves us exactly where we were ahead of this release, with the anticipation that, the Fed can probably cut interest rates later on this year, but can it do it imminently? Maybe not just yet. So I don't think it's really changed the parameters very much at all.
So let's talk a little bit then more about the backdrop and what we have seen on your side, Amanda, in the equity markets this week, where we have seen this sharp pullback in the overall averages, but also just real bloodletting in specific stocks here, and this real sensitivity to everything potentially threatened by AI. What do you think? What do you think set all of this off? What do you think is going on here? And is this just like what we can expect now?
It's a great question, and it's hard to give you a precise answer. I think it's just a sign of the times a little bit. Valuations have gotten to such lofty levels. We don't think that anything AI related is necessarily in a bubble, but certainly elevated valuation levels. And we're in the middle of Q4 earnings season, and while results are coming in, pretty solid against a very high bar, I think investors are just saying, all right, well, when is all of the return on investment going to show up for the CapEx that's going in? And then a number of the big companies said, well, we're raising our CapEx budgets. Investors don't really want to hear that. I think it's a natural sign of the times, though. I think there's a little bit of recalibration that needs to happen. It's natural, healthy, normal. We're still very much believers in the AI, automation, robotics, et cetera, secular themes and trends. So we're not particularly bothered by what's going on here. If there's a little bit more of a downdraft from what we've seen, I think we might lean in and pick up some names on a relatively more attractive basis. But what the good news is, I think, even amidst the swoon, is there's still signs of life in the broader market.
But I guess, Amanda, the problems I'm talking about are more in the broader market right now. I'm not even just talking about tech. I'm talking about a world where transportation stocks can sell off sharply because there's some tiny little stock that puts out a release about an AI product that affects logistics, or another company that puts out a release about AI in the asset management space, and you see asset managers tumble, right? And I don't know what you, as a sort of bigger picture macro manager, what you do with that, or you just don't do anything with that, and you try to look at the bigger themes.
Yeah, we try to look at the bigger themes. A lot of this in the very short run is noise, and certainly a function of elevated valuations. We started 2026 at basically the same valuations that we had at 2025. Neither points were cheap, right? So there's not a lot of cushion or shock absorber when news like this comes into the backdrop. And so I think it's just creating a little bit more volatile backdrop and a little bit of investor sort of questioning evaluations at current levels. But I think this is a short-term blip. And, the fact that we're seeing pretty significant market breadth outside of these one-off names, as you said, really gives me confidence that the rally is sustainable, even though it's going to be kind of a choppy year. I think it's going to be a good year for stocks.
And then, Jane, we have to take this conversation to what's going on in currency markets, where also things have been interesting. And I guess there, too, the question is, are we seeing a sea change with regard to, real debasement concerns about the U.S. dollar that mean, and also a policy maybe here in the US that wants the dollar to be lower. So does that mean that the downtrend there is going to continue?
You know, I don't think debasement is really happening, but I do think that there is a theme of diversification going on in the markets. And I also think that many people, even if they're not diversifying away from US assets, they want to hedge their dollar positions. And I think this is fairly obvious in FX markets, but it's also, I think, obvious in some of the equity indices if you look overseas. So for instance, from the global financial crisis all the way up to 2024, there was very much a focus on Buy America. American assets were really absorbing a lot of those portfolio inflows coming from Asia, from Europe, etc., that were really growing in that period. And if you look at, say, stock markets rebased at the start of last year, you see how the S&P is underperforming. I mean, particularly an index like the Kospi in South Korea, but also, the Nikkei. And this is evidence that investors are sort of looking elsewhere. They're thinking, look, if the Buy America trade is faulted, should we be diversifying? And you can see it very much in foreign exchange too, where there is much more interest in currencies with really strong fiscal positions. So we're talking about the Swiss franc, we're talking about the Swedish krona, and a lot less interest in currencies with large amounts of debt, like the dollar or the Japanese yen. So I think this is a really good period for other countries to sort of lay out their wares, if you like, and attract those investors into them. And I think Japan has been doing that pretty well in terms of the reforms, excuse me, in its stock market. And if it can turn around confidence in its fiscal position, I think also we can see the yen doing well this year too.
And just to go back to the beginning of what you said, Jane, just to get a little bit of precision here, how do you tell the difference between a debasement trade, a true debasement trade, and this sort of like hedging diversification trade? What's the tell for you?
Well, really, I think if debasement was happening, the market foreign investors would be really dumping US treasuries, and there is no evidence of that. So we had a story at the start of the week that the Chinese authorities were telling Chinese funds to sell or not to hold so many US treasuries. But if we look at the data provided by the US Treasury, what we see, and we have it until November, what we see is that foreign investors in November were holding record amounts of US treasuries. And actually, whilst Chinese investors have seen a decline in their holdings, well, investors even in Canada, but Japan particularly, when that's the largest non-domestic holding of treasuries, Japan, also the UK, Belgium, other countries, we're seeing their holdings go up. If there was real debasement, you'd see a real move out of sovereign assets being government debt, but also fiat currencies. And yes, we've seen gold go up, and some speculators or investors might be saying, yeah, you know what, that's evidence of debasement. I don't think it is. I think that's just the market following what a lot of central banks have been doing, which has been buying gold.
And you mentioned Japan, you mentioned the outside of US trade. Amanda, I know you've been watching what's been going on in Japan very carefully, right? We just saw a landslide victory for the prime minister there. We see the Bank of Japan making some different moves, or at least some different noise about different moves as well. What do you think about that as an alternative place to put your money right now?
Well, initially, we were worried about what was going to happen with the snap elections. And so we spent some time kind of talking with our clients and investors about, what's going on there. It seems to me like every time the BOJ and the Fed are in very different places, certainly they are in different places in terms of monetary policy here, that carry trade gets awfully strained, and it does tend to snap the market. We did see a decent amount of short-term volatility around it, and it's settled down since then. So I do think, with the elections behind us and, a very aggressive fiscal stimulus package being put forth here, that it does, make Japan really sort of interesting on a relative, valuation basis. I think it's hard to know for sure whether it's going to ultimately make a difference or not in terms of the trajectory of growth. But we do think that the equities there are certainly, relatively valued or attractively valued. And so I think we'll see how it plays out. It's a little bit early innings here, but it could be an area of opportunity relative to U.S. equities. It's just going to take some time.
Jane, what's your view on Japanese assets?
I think it's perhaps one of the most interesting G10 countries right now. So you've seen an awful lot of stock market reform. You have a huge pile of domestic savings in cash, which has been built up in the deflationary years, because obviously in deflation, you don't want to invest in assets because you think the price will drop. So the government is making efforts to try and push this into assets, and that, of course, can push equities up, which makes it more interesting, I think, for foreign investors. But the reforms in the stock market really aimed at investor returns. That in itself is interesting too. Japanese government in 2024 had a big stimulus package to really push investment into AI, but also semiconductors. That is interesting too. And of course, if we look at the JGB market, I think the market has really got the wrong end of the stick in terms of the vulnerability of that market, because the huge pile of domestic savers will, the current account surplus will always protect the JG market and the yen in a crisis position. But also most of the run up in JGB yields is really derived from the central bank really normalizing its policy and buying less JGBs. It's not really a problem of the market not finding buyers for that debt. So I think the market's beginning to settle down. If we look at the budget that has been proposed for the next fiscal year, there's only a very small amount of additional supply being proposed, and that is because of the higher growth rates likely to see a higher tax take. So I think there is good news here, and given where we are in terms of the yen, the yen is so weak, I think that also makes opportunity.
Jane, Amanda, thank you so much. Great to see you both.
Thank you.
Coming up on Morning Brief, we'll bring you today's top 10 shakers and talk about a big trend we've been seeing in the market. We'll be right back. Jitters over AI and the wider tech sell-off has shown a microscope on an increasingly skittish market here. Let's take a look. Really across the market and what we've been seeing here. But we saw it in the trucking and logistics industry. It paints a picture for a trend we've been seeing more broadly. There's a company called Algorithm Holdings. It's a company worth only $3 million. Until recently, they made karaoke machines. They've since pivoted to create AI technology for the trucking industry. The company touted new tech in a release this week on how AI can help freight scaling, and it sparked a widespread sell-off in some of the biggest trucking and logistics names. We've got other sectors that have also been vulnerable to this trend. Jared Blickery, our markets and data editor, is with me here. And this just is emblematic of what we've been seeing recently. And it reminds me a lot, I brought this up earlier in the week, of Amazon at one time. Amazon would say, oh, we're getting into the doctor's business, the doctor's office business, and all of the stocks in that sector would go down. This is like that, but like supercharged, right? You get some tiny company that used to be a karaoke company.
$6 million now, but I mean, peanuts.
Right, exactly. And somehow some algorithm picked up on that release, sent all these stocks down, then you get a pile on. But it's been happening really across different industries over the past week.
I think there's a general theme here, and we'll get into that in a minute, that has to do with liquidity. But let's check out, this is a transports. This is a scene of the crime yesterday. I put Rhyme in here because it's this little rectangle that you can't even see. But check out, I'm going to sort by performance here so you can see, and Rhyme was up 12.5%.
So that's yesterday. The company that we're talking about.
Yes, Algorithm Holdings. RXO, these are not household names, but RXO down 23%, CH Robinson 16, Landstar 15, Expeditors 15. These are logistics companies, and so off that one little press release, huge sell-off. And some of these companies just had their worst day ever. And transports, by the way, had been leading this year. Let's check out the year-to-date real quick on this. You can see most of these stocks still in the green. There's XPO up 40%. But just goes to show you, like you said, the market is on a hair trigger right now.
Well, and that's what you were just saying about looking at the year versus today. That also speaks to what Amanda Agati was just talking about at PNC, that the valuations are such that you also maybe are a little bit more vulnerable to these kinds of shocks. This whole thing started in software, obviously, where there's a more obvious and direct link between AI threats and the business, and then it's gotten more tenuous. Real estate, sure. Why isn't AI going to disrupt?
Exactly.
Real
I mean,
estate?
what WeWork was not able to do, AI is just going to get it rolling again somehow. JLL down 18%. Honestly, I don't know a lot of these companies. I do know Newmark that was down 15%.
So what set this off? Was there Specific threat?
I looked for the hair trigger and could not find one. For a lot of these, I think it's just the general idea. And like you said, it's probably just an algo surfing the internet, looking for press releases, surfing the terminals, and they find something, they latch onto it. And because of these elevated valuations, I think that's an excellent observation. Well, then you get the sell-off. Here is brokers and asset managers. Schwab down 10%, Robinhood. That's a lot more volatile. You might expect that stock to be down 14% because it's day traded like like its users.
Yeah.
LPL though down 14%. AMP down almost 14%. RJ. Raymond James Financial down 9%. So
yeah, there was a company called Altruist that apparently came out and talked about a new AI tool yesterday. So asset managers also were getting hit by all of this. So we don't know what the pace of adoption of any of this new technology is going to be, how widespread it's going to be. But it seems like
just a lot of unknowns and a lot of fear.
Yeah, I have to say the other thing that got my attention this week, Jared, is there were some new articles, some new Substacks about the threat that AI is going to be posing and that maybe we're underestimating it or maybe we're not addressing it in a policy way as properly. So I feel like when you get those vibes sort of underneath the surface, that can also affect potentially the thinking of the market.
This is what anxiety looks like in the stock market. Let's go to some of the winners though. Here's utilities, and this has just been a stalwart. It kind of came back last year as part of the AI trade, and could AI disrupt some of these guys? Probably, but a lot
AI
of them
needs this power.
Exactly. So, symbiotic relationship there. Are you going to bite the hand that feeds you? Well, leave it to AI. We'll figure that out later. But these aren't huge gains, but you can see amid a week where we're just looking at boards and boards of red, this was a bastion of strength. Another interesting one, agriculture. Big equipment, Caterpillar, one of the leaders in the Dow, if not the leader over the last year. That's going to be difficult to disintermediate, but we're seeing broad gains in this particular sector here.
And by the way, Cat's as much now related to that utility board as it is
because
related
they're building
to agricultural. They're building stuff for energy and power systems. That's
exactly.
Right.
Here's one that just popped up on my radar, home builders. Okay, I mean, long-term interest rates are going down. Maybe people are going to have more affordable housing, and maybe this is something that the projects are so long-term that they can't really be disintermediated by AI. We're just guessing here, but
yeah, I don't want to run out of time, Jared. So I want to make another point that is another chart that caught our eye, and that was a chart looking at the last time we saw this many companies in the S&P 500 fall by as much as these companies that we've been looking at have been falling, and what that indicates for the future.
Yeah,
which
this
is
was
potentially not good.
Exactly. This was a chart that came out from the Compound. It's kind of wonky, but over the last 8 days, and this was posted yesterday, the number of companies that had 7% declines in one day, and they charted this on a S&P 500 chart going all the way back to 2000. Usually this doesn't happen until we are deep into sell-off territory or in the rebound phase. We are 2%, 3% from record highs in the S&P 500. This hasn't happened since the year 2000, and that's a very important analog because that was a dot-com boom. That was the top, and I remember that time. We had tremendous liquidity in the market because back then there was a Y2K scare, the rollover.
Sure.
So Greenspan flooded the market with liquidity, and I think that kind of kept things alive, but the market was on a hair trigger because everybody realized that the dot-com boom had been overhyped, and so it was time to call some of that in. I'm not saying it's the same thing happening here, but it's interesting that was the last time we saw this kind of price action in the S&P 500 stocks.
Yeah, guys, tweet at us if you're old enough to remember Y2K. I haven't thought about that whole changeover in a while.
I was writing risk disclosure statements for companies filing with the SEC, and we knew it was going to be nothing, but we had the money supply working for us.
Yeah, there was still the worry about it. Jared, thanks a lot. Appreciate it. Hey, another guy who I think is old enough to remember that?
No, I'm not. I was born in 2001, Julie.
Oh,
Next
of course
question, fire it up. I was going to actually come on here and give you a compliment for your amazing LinkedIn post last night. Loved all your Bitcoin thoughts. I go over and check out Julie Hyman's LinkedIn page. Love that video, Julie. In fact, it was my inspiration for today because I'm all in on crypto. Key member of the Trump administration's crypto team coming on here and sharing their latest thoughts on crypto. And then, Julie, I'm coming in hot on software stocks. I've been ranting about it all week. I can't stop myself.
I was really struck yesterday. Listen, this conference I was at is Bitcoin bulls. It's avowed Bitcoin bulls. It's people who are Bitcoin maximalists in many cases. So they are, and they've also, most of them, been in it for a while. So they're not fazed by, or at least they don't show that they're fazed by what's been going on in the market, right? That said, none of them seemed particularly optimistic about a short-term rebound or a short-term catalyst coming. I mean, one person said to me, maybe when rates start to go down more meaningfully. But this was the thing that was supposed to be an uncorrelated asset, and it hasn't really worked out.
If you love Bitcoin at 125,000 in October last year, why don't you love it at 65,000?
Sure, that's what they all say.
One Bitcoin equals what? One Bitcoin. I learned that yesterday from you guys.
Deep.
Yeah.
It's deep. All right, Sas. Looking forward to opening bid.
Yeah, me too.
Appreciate it. Have some more of that Celsius or whatever's in that cup. All right, that does it for Morning Brief. Opening bid is next.